So welcome back, everybody, to another webinar organized by Princeton for everyone, everywhere, worldwide. And we're very happy to have Charles Goodhart with us today from the LSE and Markus Brunnermeier. And Charles will talk about inflation and interest rates, not so much lower for longer, but higher and sooner. And we will learn a lot about inflation threats today. Hi, Charles, good to have you with us. And I'm Manjot.
Glad to be here.
So let me give you some introductory remarks, and then we pass the floor on to Charles. So I would like to just look at the inflation expectations, and here's the 5-year break-even point. So if you take the TIPS, the Treasury inflation protected securities, where you can then from the regular securities back out the inflation expectations, what the market thinks, you see actually that, you know, the inflation expectations moved down significantly when the COVID crisis started, and now it creeped back. So it came back significantly as well. So there was first some deflation fear immediately in the aftermath of the COVID crisis in the first lockdown, and then it came back significantly at a level which is a little bit higher than it was historically. That's what the bond market expects or expected so far, and that's 5 years ahead. So what I coined the term is inflation whipsaw. We had this in this webinar series once before, that in the early phase of the COVID crisis, you have a lot of deflationary pressures and they're dominating, so they bring inflation down. And then later afterwards, you have pent-up demand and other forces, which lead to more inflationary forces, and that will dominate. And of course, for the central bank, that's a challenging feature. First, you have to put the accelerators on, and then you have to put the brakes on. And for this, you need, you know, very independent central banking and forceful central banking in order to manage this whipsaw as you likely would like to do. So there are two traps. So of course, the danger is here that you might end up in this deflation phase, and then you get trapped in this deflation phase, and then you don't get out of it anymore, and then you end up in a Japanification, so you have a Japanese situation, and that's one trap. So essentially there are two traps. One is the deflation trap, or liquidity trap, like in Japan, and you know, people start a lot of precautionary savings. The demand for money and safe assets and stores of value is going up. There's flight to safety, and the policy rate can't really go down because a reversal or effective lower bound, the reversal interest rate, if you cut it down, the policy rate even further, it doesn't really have any bite anymore. And then you might be in for a low inflation rate for very, very long. So that's one trap you might be facing. But you might also have another trap. That's an inflationary trap later on. So let's suppose you can avoid this deflation trap. You have another trap, whereas then in the long run, you know, you might run up too much inflation. And the question, how could you get up to this high inflation? And one would be that people actually run into other safe assets. And, you know, they run into real estate or other things, or they might run into foreign currencies. Or if you're a small country in particular, you have a portfolio choice. People have a portfolio choice to make to run out of the domestic government bond into foreign government bonds. And that affects then the exchange rate, and through the exchange rate, inflation might creep in. And that's especially the case for smaller countries. It's not a big deal for large countries, but for smaller countries, that's one channel which can go through that. Of course, you might also run into consumption, that rather than saving, I consume now. That leads to some consumption savings decision is distorted. That leads to high inflation because there's suddenly more demand. There might also be a supply shock from the global supply chains and other things, and Charles and Manoj will talk more about that. And there's another channel which goes through wage pressure, and that's, you know, through demographics. So there might be wage pressure coming from the demand side, the labor leisure choice of the households, but also more generally from demographics and global demographics playing out here. And all of this is really challenging to avoid, on the one hand, the deflation trap initially, and then also make sure that the inflation anchor is not breaking. So, and on top of it, what we have a huge amount of government debt. And Charles' poll question, you know, hinted at already. That makes it much, much more difficult for the central bank to act, because any interest rate increase might either bring the fiscal sector in difficulties. They have to come up with a lot more interest payments. You might end up in fiscal dominance using the fiscal theory of the price level language, or you might actually end up in financial dominance because you might bring the financial sector into difficulties. And that both of this might make the monetary authority reluctant or very difficult to do that. So of course, more generally, coming back to this inflation whipsaw, there are many forces. I've just outlined some of them. Well, some big forces are, of course, if there's higher risk, idiosyncratic risk and aggregate risk, there's more demand for safe asset, that is deflationary. There's forced saving, that's deflationary. There's, of course, later pent up demand, because now you have forced saving. Later on, you would like to spend this again, so there's pent up demand. There's an capital misallocation, so that's like a negative supply shock, that's inflationary. There's redistribution, which can be inflationary, and then there are many other things. And at the end, I think there are some elements I think Charles will emphasize a lot, is this globalization component, where we had several webinars about, do we have actually a globalization or a deglobalization? And I think the agreement from the previous seminars was that we have, on the goods side, we have a slowbalization, so things are slowing down. So we had a huge expansion the last decade, but then it's flattening and it's staying stable. But if you treat international globalization more broadly, including services and technology transfers and all that, that's a deglobalization probably kicking in. But that's, how will this play out on the inflation side, and how will demographics play out on the inflation side? Let me just look a little bit ahead. How does the market think about this inflation whipsaw? What's their thinking? It looked already on the tips, on the inflation break-even points. If you take the tips versus the regular treasury bonds in the United States, what the market is thinking there. Here I've plotted some histograms from inflation forecasters. That's from the Philadelphia Fed. You can see before the COVID, what the distribution of the inflation forecast was, this dark area, and then when there was the COVID crisis at the height, in May and so forth, it was actually then this light blue. So you see a shifting towards right to lower inflation, deflation, and you might get stuck in a deflationary spiral, and also a widening. The second element is also a widening. So people disagree much more what the inflation will be. That's for inflation expectations by professional forecasters. The New York Fed is collecting information about the inflation expectations about households. So they're conducting household surveys. So what the mean expectations of inflation is here is pretty flat, moved up a little bit, but it's always what's characteristics of households. They think inflation is much higher than it actually is. I think around 3%. Okay, so I think even though it's 2%, around 2%, I think still it's around 3% in the United States. And that's generally a phenomenon that the field inflation is higher than the actual one. So then there are two more things. So one is, how certain are they with the COVID crisis kicking in? So that's around here. You see that the error band became much larger. So people are less certain what the inflation will be. They're less, there's more uncertainty about inflation. So if you ask a person, how certain are you that this will be inflation? There will be way less certain after the COVID crisis. So more uncertainty is kicking in. What's the shaded area? The shady area is about the dispersion of inflation expectation. So that's about how different people think. So some people think, we're really going now in a deflationary mode, and other people think we're going in an inflationary mode. And I think, and Charles and Manoj, they are thinking more, they're probably more up here, others are more down there. So, but there's a bifurcation almost. So some people thinking, okay, it's way more likely we go in deflationary spiral, and that's what we have to fight on, a deflationary trap. Others think we go in the inflationary side, so disagreement, dispersion and disagreement among the households went up significantly. So with these few remarks, I would like to go to Charles' poll question and just summarize what the answers were. The first question was about lowflation, so lower inflation in the past decades, and the trend of falling interest rates. Is this because of the globalization and demographics? What role did these two big trends, globalization and demographics, play? Is it huge, large, somewhat large, small, or unimportant? And the answer was 15% thought it's huge, 50% thought it's large, and somewhat is 30%, and then 9 and 1% unimportant. So everybody agrees what Charles and Manoj will talk about today is really important. I think that's the first lesson. The second thing is, the question is, what in the US, is the political system strong enough really to reduce the government deficit? Do we expect a huge reduction in the government deficit? So what's the confidence level on that? So what is your confidence that the US political system will achieve deficit reduction? Some people are very confident, only 3%. Perhaps it will do it 22%, 35% think only with luck, but 40%, the largest block, thinks not at all. So that's another point. I think I see Charles smiling a little bit, so that's probably consistent with his beliefs. And the third question was about monetary expansion in 2020 and 21, but dramatically fall in velocity. Do you expect the velocity to return to normal afterwards, return a significant part in a way towards normal, back a little bit, and stay constant and fall? So the answers were 7, 27, 40, 14, and 12%. So roundabout, I rounded things here a little bit. And the final question was, if full employment has not been reattained by the end of 2023, so now we're looking really far into the future, would you expect the FOMC in the United States to raise interest rates when inflation is above 2%, averaging above 3%, averaging above 4%, averaging above 5%, or even higher average, or never? Okay, and the answer for that is 20%. That's essentially the old monetary policy framework, averaging above 3%, 50% thing. So that's only once it averages above 3%, that's what the majority thinks. Then averaging above 4%, that's 20% think that, and averaging above 4% thinks this way, and averaging higher and never is 2 and 4% again. So with this, quick opening remarks, I pass on the floor to Charles, and Manoush will then take over later on. Charles, the floor is yours, and we're looking forward to your grand perspective from a longer horizon and put this in a bigger picture as we see inflation risk and deflation risk unfolding. Thanks again for being with us.
Thank you very much, Markus. As you say, you were concentrating very much in the next few years, whereas I'd really rather start by talking about the centuries that we've just experienced, the last 3 centuries, because these last centuries show that the last 50, 70 years since about 1950 have been really quite remarkable from a monetary and financial point of view. This shows the yields on UK consols, very long-term interest rates. And these remained really pretty steady at around 3 3/4% for centuries, from about 1700 right up to 1950, which suggested that inflationary expectations and expectations of future short-term interest rates remained really pretty stable over that whole period. Then over the next 30 years, from 1950 up to about 1980, yields on consols rose dramatically. Inflation expectations rose dramatically, expectations of short rates rose dramatically. And then we had the reverse from 1980 to the present, with interest rates and inflationary expectations generally going to historic low levels. Now, of course, one can say that this is very largely due to the monetary regime, and to a large extent that is true, but it's slightly the same way as saying that death is caused by the bullet. And what is much more interesting and important is the context in which the bullet was fired. So why did we get the massive increase in inflation from 1950 to 1980? And the answer that I would give is that most of the people in power then, the policymakers, and indeed the leading economists, had their youth during the Great Depression of the 1930s, and were desperate to avoid unemployment, and had been handed by Keynesian economics a tool to try and control demand. And what they did, and understandably, was to try and control demand to a level which brought unemployment consistently below what in practice turned out to be the natural or non-accelerated inflation rate of unemployment. And when that generally failed, they turned in the first instance to direct controls over wages and prices, which turned out to be a failure. And then, of course, we got the crushing of inflation, which it required a great deal of courage by Volcker, Reagan, Thatcher, and so on. And then with the move to central bank independence and inflation targetry, a much better monetary regime. But the point that we want to make is that this monetary regime was operating in a very disinflationary context, as evidenced by the fact that interest rates, short-term interest rates, inflation expectations, and the rest fell steadily and dramatically over this whole period. And indeed, since the great financial crisis, despite central banks throwing the kitchen sink in terms of expansionary policies at trying to get inflation up, they've actually been failing, with the implication that the disinflationary powers in process at the time were much more powerful than had been thought. Now, our thesis, which I'm glad to say is shared by the majority of you, is that this was very largely due to the effect of globalization and demography. And this chart really talks to globalization. The left-hand chart, the blue line, shows the labor force, the working age population, available to those in the advanced economies, which was just about all that employers could use. Starting in 1980 and going up to 2010, it increased very slowly. But what is dramatic is that during this period, there was also the Eastern Europe, the arrival of Eastern Europe, and much more important, China, because China is huge in terms of its working population. And this working population effectively got included into the world's trading organization. And this effectively allowed a more than doubling of the effective labor force to any employer who could shift his production from a high wage to a low wage economy. So that from 1980, effectively employers with mobile production now had both the blue line plus the yellow line to work with. If this meant that there was a more than doubling of the effective labor force for mobile production in the course of 30 years, which was a bigger positive supply shock than has ever occurred ever in history. The blue dotted line is Africa, which Manos will talk about in a moment. The right-hand diagram simply shows how the increase in the working age population increased by leaps and bounds over this whole period up to about 2010. And as you can see, from now on is going to decline really quite sharply. Now, the increase, this positive supply shock, had three channels, at least three channels, whereby it was disinflation. In the first case, shifting production from high wage to low wage means that the relative price of those goods tended to be held down, in many cases to decline over the period. Second, it provided a credible threat for employers in the advanced economies to hold down wages. If you don't restrain your wage growth, we'll simply move our production to Hungary, Vietnam, China, or wherever. And that threat was credible and it was effective. The third effect was that there was a shift, obviously and naturally, from manufacturing to services in the advanced economies, which was made even faster than it would have been otherwise by globalization. And labor is much less strongly organized in the service sector than it is in the manufacturing sector. And both a symptom and a cause of the disinflationary effects of all this has been a very sharp or steady decline in the powers of private sector trades unions over the period from 1980 to now. And all this effect of globalization was reinforced by demography. The shift in demography was that after the baby boom immediately after World War II, from the late 1950s onwards, the arrival of contraception led to a very sharp fall in the proportion of young within the economy at a time when the baby boomers from 1965 and 1970 onwards were moving into the working age. So that over the period from 1970 to 2010, there was a very sharp decline in the number of young, much sharper decline in the number of young than rise in the number of old, because life expectancy, though growing, was growing relatively slowly at this particular time. So that the ratio of working age people to dependents was rising very sharply from the late 1960s through to about 2010. Now that's changing. The proportion of young within our populations is remaining relatively stable. The birth rate, though generally below the sustainability rate, has plateaued, while the number of retirees is starting to increase rather faster. So with the exception of Japan, which had the massive increase in retirees earlier than any other country, during the period up to 2010, there was a very strong shift in favor of those in the working age population, which has now started to reverse and will continue. Now, if you get many more people in the working age population, that in itself is disinflationary because you don't hire a worker unless the value of their work is greater than the wage or salary that you pay them. Moreover, they're having to save for their retirement. So an increase in the proportion of workers is disinflationary. And in addition, during these years, because of the decline in the birth rate and the greater availability of consumer durables, the proportion of women in the working age population who were participating in the labor force was increasing by leaps and bounds. So again, that was disinflationary. What is more, the old are much more inflationary than the young because the consumption of the old in the form of medicine, in the need for care, and in pensions is growing. As you can see from the blue line, the life cycle, the consumption goes on rising as you get into your older age. And this is very largely because of the needs of the aged, in particular, the medical needs. Medicine has been absolutely wonderful in dealing with cardiovascular and with cancer, but it has so far completely failed to deal with neurodegenerative diseases. And the proportion of the old getting neurodegenerative diseases is an exponential function of age. Between 65 and 75, a third, between 75 and 85, about half, and over 85, which I'll be next year, up to 80% of those there require care and require increasing support if they are going to be able to survive in a decent old age. And that is very expensive indeed. Now, what then, of course, has happened is that the shift of production from high wage to low wage economies, in particular to China, has had the beneficial effect of improving world equality. World inequality increased from about 1800, when we were all pretty well marred in the subsistence level. From 1800 to 2000 and to about 1980, 2000, America, Europe, and certain other countries bounded ahead with the Industrial Revolution and so on, but much of Asia remained marred at subsistence level. And what has happened since 1980 is that Asia has begun, particularly North Asia, has begun to catch up. I think that the column on the left is perhaps the most dramatic set of data in our whole book, showing that the ratio of the average wage in the US to the average wage in China was 35 to 1 in the year 2000, and it had fallen to 5 to 1 by 2018, a change of 7 times. And there are far more Chinese than there are Americans. And all that has meant that if you look at the world as a whole, if you're worried about world equality, since 2010, things have got a lot better, as Malinovich has actually shown. It's true also that relationship between Western Europe and Eastern Europe, though less dramatic. Relationship of wages in France to that in Poland has shifted from about 4 to 1 to about 3 to 1 over this same time period.
Charles,
So,
can I ask you a question
yeah,
about the earlier thing is, so you emphasize a lot international aspects, but if you look at the country like the US, which, you know, is of
that
course,
I'm coming to.
okay.
The problem is that if you're going to shift production from high wage to low wage, what you're going to find is the low wage workers within the advanced economies are going to do relatively badly.
Mm-hmm.
And this fact shows that because of the shift to the low wage economies, those with whom they're particularly in competition, the less skilled in, particularly in the US, have done really dramatically badly over these last 30 years. But if you had access to human capital, financial capital, technological skills, managerial skills in the advanced economies, the last 30 years have been absolutely wonderful because the low wage economies needed those skills in order to employ their low wage workers to produce the manufactured goods that the world as a whole wanted. So what we've had is a massive reduction in inequality between countries with an equivalent, very large, but not quite offsetting, increase in inequality within countries. Now, in economic terms, the labor force within the high wage countries has been screwed over the last 30 years. But politically, what this has meant is that they have moved very strongly towards populist types policies for fairly obvious reasons, again, in large part because of globalization. Many of those in low wages within high advanced economies blame immigration for causing their particular problems. Whether they're right or wrong to do so is not immediately germane here. But one of the issues here is that right-wing type policies tend to be anti-immigration, and left-wing type policies tend to be more pro-immigration, which has been one of the reasons why immigration has become so politically important as an issue and has affected politics in Europe, certainly in my own country with Brexit, as well as elsewhere. Now, the increasing number of the aged and their need for care, medicines, pensions, and so on, has meant that well before COVID was ever thought of or appeared in China, it has led under present policies to an expectation of very sharply rising deficits and debt. Now, this was the Office of Budget Responsibility, our equivalent of the Congressional Budget Office in the UK, showing in their publication in 2019, taking the data up to 2018, what the forecast was on present policies of expenditures and taxation for deficits and debt. And this is, again, very largely because of the very considerable increase in medical costs and in pensions costs that we have. The same was true, of course, in the US, but the US now has the same kind of prediction, including the COVID pandemic. And there you can see the pandemic leading to a step change in 2020, no doubt in 2021. But the increase, the exponential increase, is not just due to the pandemic. It was there beforehand. It is due to the aging structure of our populations. The question is, what are we going to do about such a situation? One of the things that is sometimes said is we know how to deal with inflation. It's much more difficult when the debt ratios are so high, as you actually indicated in your opening comments, Markus. So what's going to happen down the road? What's coming down the road? Well, the first point that I want to make, and it's a very important one, is that growth is unlikely to help. And the reason that growth is unlikely to help is that the number of workers is going to grow very much slower in future than in the past. And in the strongest growing countries like Germany and China, it's actually going to turn down. And with a decline in the rate of growth of workers, you have to have a really dramatic increase in productivity to offset that. Now, we do believe that productivity will rise because the slowing of globalization, perhaps to a degree it's reverse, will lead to an onshoring of investment and will lead employers to try and offset the reduced availability of labor in our economies by trying to employ workers much more efficiently. So that we think that productivity will increase, but only modestly. Now, as I think most of the audience already suggested, there's a great deal of doubt whether the politicians would be prepared either to reduce expenditure or to raise taxation by the extent that would be needed to deal with the prospect of ever increasing and quite strongly increasing debt and deficits, because increases in taxes and reductions in expenditures are, for obvious reasons, politically poisonous. So that we think that the result inevitably will be inflation. It'll be unattractive, but we think it's going to be necessary to actually bring down the very heavy debt ratios that we now have, given the political conditions in which we live. We think that a degree of inflation is going to be politically optimal. The problem that we faced was, what was the timing of this? Because the changes of these trends, we believe really fairly certainly will increase inflation, but at what point? Because labor bargaining power was so trashed by the last 30 years, it'll take a time for labor bargaining power to recover. But then we got the pandemic, which you concentrated on, but is really almost a sort of postscript to our arguments. Now here, as you pointed out, the monetary aggregates have been dramatic. In the US, it's been the fastest rate of monetary growth during peacetime, and about 2 or 3 times what it was in previous years. And with all the debt and the fragility of the private sector is going to have to raise its markups in order to try and raise the profits, in order to pay back its debts and remain solvent. So we think that the pandemic will bring forward the shift from a low inflation to inflation returning earlier than most people think. Your whipsaw, Markus. Now, still, we believe we're not in the mainstream. So I want to turn over to Manoj now to set out some of the reasons and the arguments that he used against our proposals and our viewpoint.
Can I just, before we move on to Manoj, sure. Some questions from the audience. Some people think that, the healthcare expenditures, they agree that they will go up, but there's also a lot of room for improvement because especially in the US, it's such an inefficient, if you have some price control or some, monopolistic buyers, what you have in many other countries, there's a huge room for improvement to reduce prices actually for health expenditures.
Oh
And
yes, there's a huge room for efficiency in health, but do remember that what the old who are going to have these neurodegenerative diseases need is personal support and care from people. I, uh, you know, my older brother died of dementia about 4 years ago, and what you need is people to look after you, and that takes in Japan, it is now expected that something like 10% of the workforce is going to have to look after the old. And that means that that's another reason why the availability of workers for other purposes is going to be cut back. Um, uh, we old people need a lot of personal help, and that cannot be done by robots. Robots have an emotional quotient of exactly 0. And what you need is empathy. One needs help and one needs support when one gets old and one can't do things that one used to be able to do. So Manoj,
but why is inflation the optimal answer then? Because
it's
you
not
essentially pay.
optimal. It's not necessarily optimal. What we're saying is that the political pressures will actually lead it's politically optimal from the point of view of any government. They're trying to raise taxes and lower expenditures. I don't want expenditures to be lowered. We do in the book have some suggestions for taxes that could be increased. Um, but any such increase in taxes, let me take one example. Most economists think that taxing carbon emissions is a very good way to go. When Macron tried to do that in France, he got the Gilets jaunes, and he found it extraordinarily difficult. Even taxes that have intellectual support from the greater proportion of economists run into great popular difficulties. And because they run into such popular difficulties, and because they would need to be quite significant, we think that the politicians will not have the strength to introduce them. So inflation will come in as not optimally, but as the least worst outcome from a political point of view. It's political economy.
Marcus, the other thing to keep in mind is if you
Mhm.
look at even a rejoinder to what Charles was saying, raising retirement ages just to make people work harder than they would have to. I mean, it's political suicide in most cases. Even in Russia, where President Putin has such a strong hold on local politics, that's the one thing he was not able to do. And the second thing I would point out is if the pandemic has shown us something, particularly where Charles and I are, is that we are heavily underinvested in healthcare. And that is something that even if we increase the efficiency, the sheer increase in the size of the problem that we are facing here that we do not yet see in front of us is something that is going to keep health expenditures in aggregate pinned very, very much to the upside.
So I understand and I agree, but inflation essentially you also lower real wages and you make people work at the lower real wage.
But that again, as the availability of labor falls and real wages get under pressure because of inflation, that's another reason why we think that workers will start to recover their bargaining power and will start raising their demands for higher nominal wages to offset the inflation.
Enough.
And if they're taxed, that will go a wedge further. But
so can you give us a time frame? So with the COVID crisis, probably you think it's speeding up the process, but when do you predict will inflation creep up?
Well, in the
about
first
decades, or talking about 2 years or 1 year? Or?
well, in the first instance, a rise in inflation will actually be not only accepted but welcomed by the central bankers. Average inflation target, offsetting the undershoot of the previous years. So unless inflation actually rises above, shall we say, above 4% at the end of 2021, this year, and say by about halfway through 2022, it will be accepted and will be regarded as a benefit, as as a success for monetary policies generally. The question, and this is the real question, is not whether there's going to be a blip in inflation as we all start using the money that we haven't been able to use to do things we haven't been able to do. And I think that there will be a blip. The question is, when we get into 2023, if inflation is still strong then what will happen? The central banks are going to welcome a degree of inflation immediately. It's going, what happens towards the end of 2022 and 2023 that's really going to matter.
We're keeping a benchmark for seeing inflation around 12 months after a successful round of vaccination that allows economies to open up. So the longer that takes, the bigger the hiccups. We have a rolling window. But once the vulnerable and the frontline workers are vaccinated, and that allows the economy to start opening up, we think a year at the most is when we will see inflation pick up.
So it's really after summer. The general hope is that this pandemic will be behind us by summer this year. So it's really by summer 2022 that we think that the issue about are we worried about inflation will really start to hit.
So can I perhaps come back to history a little bit? Perhaps you can allude to that as well, that after the First World War, the UK was actually able to go back to the gold standard and got in a huge deflationary mode. Why was it so different then compared to now? Of course, Germany went the other direction after the First World War.
And so did the US. And the US had the roaring 20s, if you remember.
Yes.
And that, to some extent, is the analogy that I think we might well think about. After the flu epidemic in, I think it was 2018, and the wartime privations, everyone wanted to go out in Charleston and go to nightclubs and all that sort of thing. And after the privation and the lockdown, I think a lot of us will want to catch up with the entertainments and the travel and getting out of the winter into sunny countries that we've all been missing.
Markus, if you looked at Charles's explanation for why we saw that increase in console yields and the motivation of people to do so, one of the things that he had mentioned, which I always find really interesting, is that you had this new tool that people wanted to manage aggregate demand with, Keynesian economics. And that's not very different from the proliferation of modern monetary theory right now, which is being touted. We don't agree with it, but it's being touted as a panacea for all the cures that we have, all the problems that we have ahead of us. That's something that has already been deployed, even though they don't say so. And I think that might have a similar effect as well.
So do you have a take on the debate, whether the growth rate of the economy is larger than the real interest rate on government bonds, and hence we can not worry about
the way we see it is that the growth rate is going to come down. I don't think there's really any question about that. And we'll be very lucky to be able to do as well as Japan. And if you want to talk about Japan, that Manoj can do that.
Well, that's not obvious. Some people say we have now all this new innovation, everything is sped up. We have telecommuting, telemedicine, everything will be way more efficient, especially as, the COVID crisis forced us to innovate.
And Gordon thinks the opposite. That all the low-hanging fruit have been picked. And there is a very, very strong debate among those who deal in that particular area of expertise, whether technological innovation is going to accelerate or even slow down. That's not an area in which Manoj and I have particular expertise. All we can say is there are very strong but equally very widely dispersed views on all this.
If you even take that argument further, right, just one small thing to add, which Charles had already alluded to before, is that in some senses, the data and the projections we're getting from the CBO on dependency ratios are actually not economically telling us the whole picture. if we're right about the crisis of caring, which is a chapter in our book that we've dedicated a lot of time to, the more you take away people from what we would loosely term as economically productive employment and get them to look after the elderly, which is socially productive, but that's a service that is consumed one time and then never used for anything else because the elderly will not go back into work. That makes the story a lot worse. And in some senses, we need technology to reduce employment in repetitive tasks that can be done by automation or by AI, because a lot more people will be required to move into these socially productive but economically unproductive tasks. And if they don't do that, then I think the problems that Charles and I have been highlighting will be significantly worse. So we take for granted some of the things that you're saying about a lot of things becoming efficient, but that is something that is a crucial part without which the problem is actually a lot less manageable.
Can I come back to demography as well? Because I totally agree that, you know, Eastern Europe opening up and China opening up and bringing millions of additional workers into the global workforce made a huge difference. But to what extent can we have immigration? There's always a claim, you know, the population is not growing, but of course you just open up the country and more people will immigrate, in particular from Africa. And then you have the whole population explosion going on in Africa. Can you not repeat what we did with China? We repeat the same thing with India, but there's still a lot of population explosion, and also with certain countries in Africa. What's the argument against that? Actually,
Markus, the last three questions are something I'll address very quickly. If you don't mind, I'll jump through some of these slides, and you'll get a few more, and then we can take it from there. So in fact, a lot of the questions you've asked are really, except the ones in Japan, are the ones that you've already talked about, and these are the 5 main bits of pushback that we get and we've been receiving as we've developed this argument. And the first one is the last question you asked, which is Africa and India. And we actually have very benign paths in mind for these countries. So India's got a significant period of growth ahead of it. About a third of African countries actually have a better score of ease of doing business than China even. And certainly 2/3 of them are higher score than India. So we have a lot of faith that they will do well. But the question is whether the numerical tailwinds that you see in terms of demography can actually be economic tailwinds globally. That's where the problem lies, is that the vast overwhelming majority of contributions to growth right now come from economies that are going to be going to see aging labor force. And it's very difficult to think that we will construct 1, 2, 3 Chinas out of Africa and India for the following reasons. Number one, when China was growing, you actually had a lot of help from consumers in the advanced economies, particularly the US, which allowed them to supercharge their production. And keep in mind that for the large proportion of the last 3 centuries, China has actually been the dominant power. So they have a huge system of trade unions, a huge system of apprenticeship, of guilds to fall back upon, which has meant their work ethic and knowledge base for workers has been significant. Now, India has a lot higher human capital in that age group or in that group of countries, which still has benign demography. But if you look at somewhere like Africa, for example, they've got the same size of the population as India, but they've got 50 countries among which they have to have coordinated policies if they want to look like China. India's got a massive problem with center and state negotiations. They're always in conflict with each other. So coming up with a national policy, as you saw in the VAT arguments that they had, which had to be watered down, is difficult. But primarily, I think the immigration problem that you alluded to is politically very, very, very difficult. If the political climate totally changes and we don't have populist governments in charge universally, then yes, we could get a significant influx of immigration. If that happens, we'd be happy to change our mind. Neither Charles nor I want to be right in our debate. It's just what we think is going to happen. The other choice, which is, well, why not take capital to these economies, convert it into output and ship it all back, is harder because of these administrative problems that I alluded to. So while we see they will do well, we don't think they will do well enough to get the world out of its problems right now. The other three.
Sorry, let me just take an example. Last year, Ethiopia was regarded as one of the leading lights, and its growth rate over the last few years have been really extraordinarily good. And we've only got to look at what has happened to Ethiopia in the last couple of months to realize some of the problems that Africa faces in this respect.
I see. Okay.
Go ahead, Markus. Look, I mean, from our point of view, I just wanted to add in 2 or 3 things, and then I'll hand it right back to you. The big question that we usually get is the one on Japan. I'll skip a few slides here because we've already gone over most of that. And the one question that we get in Japan is, look, why didn't any of our thesis play out in Japan? And again, that's an important point, and we've dedicated an entire chapter to it. And the simplest way to think about it is that Japan had its demographic turn when China was busy disinflating the entire world. So one of the problems of analysis of Japan has been that most of the analysis has been autarkic. When Japan had a falling labor force, it actually did not have any way to stop the disinflationary forces coming from China at its doorsteps. In fact, if you look at the one chart that is probably worth looking at, it's not in the literature, and we're very happy to have gone into METI data to get it out, is that over the last 20 or 30 years, Japan, the corporate sector, actually recognized this global trend and invested very, very heavily outside. So their overseas manufacturing ratio, their employment ratio, their investment ratios all went up linearly in a very profit maximizing manner. So rather than have this picture of a corporate sector debilitated by deleveraging in Japan, actually they were looking at an economy that had significant problems at home and a global economy that provided vast opportunities and behaved in an extremely optimal fashion. So if you take away some of those objections, just to conclude very quickly, we do think inflation is coming. We think it's coming faster because of the nature of the stimulus, which is this time gone to households and firms. We think the yield curve steepens because like your questionnaire showed, we don't think central banks will manage to act very quickly. We think asset returns will be harder to extract. That lower in-country inequality problem that we had talked about before will fall. But perhaps one of the most significant changes that will come about is that central bank independence, something you had mentioned in your earlier comments. You need strong central banks to act against independence, against inflation. That's something that will come under renewed and increasing threat as we go ahead. But that's it from me. I'll turn it back over to you.
So let me ask some questions from the audience as well. So Marcel Fratscher would like to know, what is about central banks? Why won't they have enough power when you talk about monetary dominance versus fiscal dominance or financial dominance? Is it you think that the central banks will not have enough independence that they can actually enforce their mandate, and they will go down in history as saying, okay, we give up on it? And Charles probably goes even further. He would say, oh, they will initially declare this as a victory and then realize they can't go back and bring it back to an inflation target of 2%.
I think that you have a difference between the ECB, whose independence is protected by treaty, and virtually every other central bank in the world. And one of the key points that you need to remember is that the appointments to central banks, either to the governor, chair, or to the policy committee, are usually made by the politician. And if the politicians don't like the policies, they will change the people. And at the extreme, if the politicians are sufficiently annoyed and find that they cannot change they don't have the speed with which to change the appointees, they can change the act. What one legislature introduces, another legislature can change. Ultimately, the power of a central bank to operate independently is really quite strictly limited. The politicians ultimately have the whip hand, with the very important exception of the ECB, because it only takes one country to veto the treaty change, and the ECB remains in position. So Europe may have a very different outcome from the rest of the world.
The critical story really is that of the Fed. I mean, if you look even in the last few months that we've had, it would be unthinkable up to 2020 to think that emerging market central banks would use quantitative easing. And so if the Fed bends the way Charles has described, I think it will not take very long for other central banks, whether it's developed or emerging, to really jump upon that bandwagon. So that's the critical debate, I think, that we'll have to look at over the next few years.
So overall, you think this very much as a dominant global force, the whole labor supply force will go down. But you still see them differences across the countries, across the continents, how they will react to that. Is this correct? I mean, the ECB might be more conservative than other parts of the world. If you were to ask yourself, what is the optimal thing to do? If you were in a blue sky environment and say, we can actually optimally design, ignore the political pressures, would you go for higher inflation given the labor supply changes dynamics?
No, what I would do is actually set out a bit in one of the chapters. I would go for an increase in a number of taxation. I would increase carbon taxes. I would go for a land tax, particularly an urban land tax. I did one or two other taxes. I can't actually remember. There was a third one. I can't remember what that was.
Border-based tax, Charles, that we had talked about.
Oh yes, a border adjustment tax. Yeah. Some of the tech companies have got away with murder in terms of competitive advantage with ordinary retail high street, and that really needs to be changed. And the border adjustment tax. Otherwise known as a destination-based cash flow tax. So a border adjustment tax, a land tax, and a carbon tax, and use those to reduce the deficit sufficiently to stabilize the debt ratio and keep inflation at 2%. That would be my optimal. But I wish I believed that the political system was such as to enable what I think is least harmful taxation to be introduced.
Charles, do you want to talk for a second also about the other point you had made on this category, which is the equity financing instead of debt financing?
Yeah, well, that's that's also a key issue, which is that one of the great problems that we've reached is because the very sharp decline in interest rates has had much more effect in shifting adversely leverage to a much greater extent, while not having anything so much effect on investment expenditures. So the impact of the lower interest rates has not been that beneficial. And the reason for that has been that all the incentives for management at the present moment was to maximize relatively short-term equity increases in order to increase the return on equity and get their own bonuses upwards. And I think that we have to change that capitalist structure. I would do so initially by withdrawing limited liability from senior management. At the extreme, I would like to see the CEOs of our major companies having unlimited liability, as they used to have in the earlier 19th century.
So would you go so far, even if the Fed has some bond purchasing program, you would only buy bonds of companies, corporate bonds, if they have some unlimited liability for the management to incentivize?
I think you could do that as well, and that would be a further twist. But it's not going to happen, Markus. This kind of change to the structure of capitalism, particularly damaging to the pocketbooks of our biggest businessmen, is not going to happen.
Let me come to another point, because I see two arguments in your book. Essentially, one is very much the demographics and globalization, but the other one is the high public debt level. And that was the case after the Second World War as well for the UK and the US. And one way we got down the high public debt level was through financial repression. So it was higher inflation combined with financial repression, but we probably don't have the same tools because capital markets are much more flexible. There are way more ways to escape, essentially, and not be subject to financial repression. Would you still say, okay, we need this high inflation, even though it doesn't help us so much to bring the public debt level down?
It's not that we need it. We think that we're going to get it because it's politically the easiest way out. I think that there will be an attempt towards more financial repression. I think that as it becomes difficult for the government to sell their bonds, So there will be an attempt to ensure that financial institutions of a wide range are required to hold a larger proportion of such bonds.
Markus, if you look at the debates around then, right, and I think one of the key differences was that that event ended, wars ended, and so we were able to use inflation to actually reduce the debt to GDP ratios. Here, the process of aging isn't going to end. So even if you get inflation in for a little period of time, you will only reduce some of the burden of debt for a limited period, while the overall debt continues to increase along the lines of that public expenditure debate we had earlier on. There's no relief as such.
So if I may summarize, in a sense, the only hope is that, given that we don't allow immigration, is to develop technologies that we can do de facto immigration by some people help us from outside of the advanced economies to smooth out the population dynamics. Is this, and Charles would say, you know, you need some, if you're an elderly care, you can't just have somebody zooming in from India to help us, I guess.
And if I had my way, what I would like to see is medicine making sure that a lot of us older people can work for longer and don't require help. I would like to see medical advances. I have to say that our view is pessimistic. It's much more pessimistic than mainstream. And I have to say, I hope we're wrong. I fear that we're not wrong. And the other thing that I would add is that I believe that the story we tell is a coherent and undoubtedly a very possible one, and that I think that many other people like yourself will have to think of how we would get out of these kind of difficulties if indeed they do develop. I think that this lower for longer one is just a sort of Pollyanna primrose path. You know, we can go on borrowing and printing money forever because inflation is just held down miraculously, whatever happens to available labor supply.
So typically we end with a positive note, but before we do that, I would like to ask another question. So why do you think the market gets it so wrong? And if you want to, you know, take an investment decision, you know, what should you do now? You're saying, given if somebody shares your view, you buy some tips, or what do you do in order to protect yourself against this inflation increase?
People always give much too much weight to the immediate past. As Manoj has frequently said, if you ask the question, what will the future bring in 1980, 1981, 1982, people would have said that inflation would remain high. And expectations were that interest rates would remain high. And the market is also, I think, puts much too much faith in the Federal Reserve and other central banks being able to keep inflation down, come what may. You know, don't fight the Fed. It's a combination of don't fight the Fed. Most people working in financial institutions, most traders, are under the age of 45, and they've only known very low inflation. So why should they expect anything else? And particularly when they're told by the majority of mainstream macroeconomists and every central banker in town that inflation is going to remain low forever, why should they believe anything different?
I think there's also a degree of overconfidence. If you look at that intervening decade between the financial crisis and the pandemic, there were several bouts in which the interest rate path of the Federal Reserve was set at higher levels, only to eventually come down to market pricing of where that would be. And at the time when the Federal Reserve did actually start raising interest rates aggressively towards the end of that decade, a significant amount of impact on global growth, so these tantrums as we call them, and a hit to domestic growth in the US economy in terms of housing or capital investment not picking up. All these things, I think, reinforce the past to a very large extent. But to answer your question, what should you do if you share our view? First of all, there are more and more financial institutions that are thinking of inflation numbers as a hedge. So it's not just break-even inflation, even 30-year inflation, which is extremely low and will be more relevant for places like credit funds. There are institutions that are putting bets on those numbers rising. But the second one is trying to think about where you could get growth out of, and that's unlikely in the advanced economies, but far more likely in some emerging markets. So I think a smattering of changes in their stock picking in places where productivity could rise because of the technological forces you mentioned, and just looking at where inflation protection is still cheap, I think is the combination to go.
So I end with a last question, then you have to give me a positive end note, because it's a very negative look into the future. If heads of major central banks would come to you and say, okay, I recognize the dangers you're pointing out, and I recognize that the political pressure will come for me how should I prepare my central bank or my country to lean against it? What should I do? What are the important steps to watch out for? What are the important steps to take already now to make sure that this is not going out of hand? And then I would like both of you to give me an optimistic note, give it not only the pessimistic one. Some ways and path forward. How can we manage then the challenges in a positive way, in a less detrimental way?
Let me put it this way. The aging structure of our population is going inevitably to lead to a considerable increase in public sector, inevitably and rightly lead to a considerable increase in public sector expenditures. In order to handle this, we have to think of offsetting increases in taxation, which do not severely damage either equality or growth within our economies. So what I think we need now is a very deep thought about the structure of our taxation and our fiscal policies. As I said, I've made a number of these suggestions. I think we have to go down that route.
So just from my side, sorry, go ahead, Markus.
Now, just to summarize, you would like to put some taxes in place which automatically increase over time, in a sense.
No, that increase. It doesn't have to be all that huge. It's not necessarily terrifying, but the tax increases that we think are necessary are sufficiently large to be politically extraordinarily difficult. That's the problem that I think our economies face.
Manoj, sorry.
So I would say that just if you want a note of optimism, something that you had mentioned before, I think seems to be and something that Charles had mentioned before. The first thing you could think of is just that perhaps the optimistic side in me would say perhaps we are waning as far as populism is concerned. A lot of the bets that have been made on populist governments returning the days of yore where everyone could borrow freely and cheaply and house prices would go up, those have not really panned out the way, and they never were going to. But perhaps the end of that entire trend might lead to greater immigration, whether it's point-based or depending on the needs is irrelevant, as long as there is more openness. That might be the way to go. The second thing is the participation and the role of women all over the world is still something that you can get a significant amount of bounce from, but we're not giving it as much attention as it deserves. So particularly in the emerging market economies, the role of women simply hasn't picked up to anywhere close to the level in the advanced economies. And that's a huge human resource that can be brought to bear. Even if these two things turn around, I think it will put a significant dent in our thesis, which really would make us very happy. But we don't want to be miserable either.
Very good. Thanks a lot, Manoj, and thanks a lot, Charles. Good to see you again, and hope to see you in the real world soon again in some central bank conference or somewhere. And I will keep worrying with you and hope that things will turn out better than you predict. Thanks.
That would be nice. That would be very nice.
Thank you.
Thank you, Markus. We enjoyed that a lot. Thank you.
Thanks.
Bye.